It's the end of September. You're a portfolio manager. You're looking upon the quarter. You say to yourself, I have an S&P with a valuation at 2,900, and I've got a 10-year at 3.20. Okay, now let's do the math. What are we going to do in that environment? Well, you're going to see a little bit of a rotation. Okay, you're going to buy some bonds. You're going to pare back your equity holdings. Now you extrapolate forward into this quarter, and you're looking at a 2,400 S&P and a 275 10-year. Listen, you don't need a calculator to know what to do in that environment. And that's what you're seeing here. At the end of quarter, portfolio rebalancing.
You still got, half of that amount or thereabouts still to go. You wouldn't be surprised that, if stocks are able to close up today, if they're, able to close up on Monday, New Year's Eve, and then maybe on the 2nd as all of this rebalancing takes place. Big investors that I'm talking to, separate from ones that may have been involved in what we talked about earlier in this phone call, are certainly thinking along those lines, that's the biggest story in the market right now.
And as much acceleration as we had, in particular, of course, on Christmas Eve. But then on the 26th, when we came back, Boxing Day, and we saw, just the market trying to put up that 280-point rally, Judge, sold off hard, pushed it all the way down 80 points, and then we see that 1,100-point ramp. During that time, not only were there a ton of calls being bought in the SPY, which we talked about, but there were also an awful lot of folks who stopped. They didn't put their foot on the gas to the downside in any of the FANG names at that point. So that was a big turn for me because those had been leading. Whenever I looked at my scan of, winners and losers on the market that day, I'm looking at, all the top FANG names were down 4%, 5%, 7%, things like that. On Wednesday this week, that wasn't the case. All of them ran to the upside like crazy. Amazon, of course, led the pack because of those retail numbers, and they were up 9.5%. But Facebook was up 8%, Apple was up 8%, all those. And then they didn't give it back yesterday. And many of them built on it and are building on it again today. So the fact that you don't have that acceleration pushing to the downside is another reason. I think they're just, the bears are losing that one other thing that they had, other than the turmoil in Washington, D.C., and that was they don't have end-of-year tax loss selling for more than another 10 hours. Then they don't have that as a catalyst.
On this question of why is the market up, the bull case is the economy is fine and profits are in good shape. Certainly, we're below 15 times what this year's earnings estimates may come in. The problem is none of us are sitting here saying that the fourth quarter earnings report is really going to juice the market higher. I find that very interesting. Usually this time of year or this time of the quarter, we're saying, hey, can't wait for profits to come out. The reason is, in the absence of a trade deal, we know, or expect rather, that the vision going forward from CFOs and CEOs is going to be cloudy at best and possibly negative. That's why I go back to two things that I'm focused on. One, we need a trade deal. And Ron, to your point, yeah, it is going to take time. It's not going to happen in January. Hopefully it gets done in February. The upshot of this is we're in for more volatile times, Scott. It's going to be up and down and up and down.
What if it's just as simple as, when I talked to David Tepper the other day, as stocks were declining, it's like, well, I've been nibbling because the market just came down too much.
Yeah.
I mean, you don't need to be a rocket scientist to just judge it on the surface, right? The market was down a lot. A guy like that looks at it and says, this is kind of ridiculous now, and I'm going to start nibbling. And it's also probably worth saying that, Tepper's nibble, as Leisman was saying at my desk, is another person's whole Megillah. So,
well, when you're
don't
managing
just view it as
$30 billion or whatever it is.
Right.
Yeah, I think the other point, though, too, Scott, is and correct me if I'm mischaracterizing what he said, but he said he was nibbling in individual stocks. He didn't necessarily make a market call. He found some value in the market because how much we'd come down. So you don't know, as a hedge fund manager, if he's short S&Ps but long other stocks because he still thinks there's another leg down. And I'm not putting words in his mouth. I'm just saying that from the perspective of someone like him, you could still think the market's got another move to come, but Apple or something else is cheap.
Let me say what I think is fair to say from my sort of understanding of it. It was more than just XYZ name here, that, and the other. I think he looked at the overall market and said, this is kind of absurd at this point, based on where I think we are. So I'm willing to nibble, in his words. And by the way, the S&P's up, I don't know, 4.5%, almost 5% since then.
Good month for him.
I think investors need to figure out which camp they're in. You're either in the camp that there's going to be a recession in 2019, or you're in the camp that we are just experiencing a deceleration in economic growth and a deceleration in earnings growth. If you're in that second camp, which is where we're at, it's a great opportunity for you to identify those names that you'd like to be in late cycle.
Unless you think that this is nothing more than end-of-year seasonality, rebalance, et cetera. You get into the first couple weeks of the year, and then you revert right back to the place where we've been. Worried about the Fed, worried about their message, worried about trade, worried about tweets, and everything else comes right back front and center.
Well, and to that point, what degree of confidence can you have in any outcome, whether it's that the Fed reverses course, whether that there's a trade deal with China, whether that it's Trump backs off on the tweets? The degree of confidence in any of those outcomes is necessarily very low. So you make a great point. What camp to be in?
Shannon?
I can't tell you. I need to wait to see if a China trade deal comes through in the next 60 days.
Right.
I think the biggest challenge is that in all of the crises that Ron discussed, there was a storm, one big storm. Now there's several small storms, and as we're trying to navigate that, each of those keep cropping up, and one of them we have to be able to hit one or two of those, move them out of the way to be able to get confidence that we can move higher in the equity market through the end of next year. I keep hearing, it's a self-fulfilling prophecy about a recession. The reality is that we are seeing deceleration, perhaps not deterioration, but deceleration in the global economy. That will affect us. But the reality is that if you're not able to move past the fact that you don't want to be in energy stocks because of supply issues, and you don't want to be in industrials because of tariffs, and you don't want to be in financials because of the curve, there's not going to be this breadth of a move higher through next year.